So risk management in finance, and we start with insurance. And yeah, so this is the entire third chapter. Today still we will be talking about 2 chapters, and from the next week it will be reducing sooner or later to 1 chapter, because the quantity of the material or the density of the material will increase. But today still we'll just focusing and defining the different segments of the risk management market. So if you have to talk about insurances, obviously the definition is that we have some event, a well-defined event, what matters a lot, and for this really nicely defined event, or against this, we have a policyholder who can be harmed by this event, and that's why the policyholder makes regular premium payments, and in case of the event happens, then they will get some also certainly specified payments. And that's why in the case of insurances we have to be able, so we need some theoretical mathematical model to describe the appearance of these events, and this is actually the trick of the entire insurance industry, that you need a big database where you can define the probability of the appearance of such events. So it doesn't matter that we are talking about life insurance or property casualty insurance, you need some data. So we can say that big data analysis in the insurance sector is quite old, because since in the last, let's say, 500 years, so 5 centuries or maybe more, there are insurance-like products on the market. So it's highly built into the sector to deal with this one. And also the other thing is that usually catastrophes are not insurance. So for example, if one meteor comes and destroys an entire city, this is not up to the insurance company to deal with. So in this case, this is to rebuild an entire city, it's up to the state. So we are not able to manage it on market basis. This is when we have a state, and the state has to do its functions. And also, in many cases, insurances must be limited to avoid the default of the insurance company. And obviously, the business inside of this insurance is that we can invest these premiums on short run or maybe long run, because we can purchase some kind of asset. It can be mostly or usually government bonds, or if we have a deep and highly developed corporate bond market, then it can be also corporate bond, but obviously in A or AAA rated categories in companies where the partner risk is limited, or at least we can assume it's limited, and it can be also money market funds or short-term assets or bank deposits. So they can invest into something which pays interest to the insurance company, and after that, on this basis, they can build up their profitability until they can predict well the payments and how they are happening. So if they are thinking about life insurances, because the book says, and usually we have this distinguishment, so we have life insurance and non-life. The book says that it should be called property casualty, but also health insurance is also connected here, so I think that non-life would be more appropriate. So in the case of life insurance, obviously it pays if the policyholder dies, or in the case of endowment, it pays if it survives. So it can be another thing. Or in the case of annuity, you are making a big payment at the beginning of the contract, and then you get regular, or you are paying, sorry, the premium at the beginning of the contract, and then you get regular payments until you are leaving. This is not the case in the usual insurance business, because usually we have payments, regular premiums, and then if the event happens, we get the payment. So that's why annuity and endowment, they are special in this term. Okay, so if we have to talk about life insurances, then now I told already about annuities. So there is this lump sum premium. It means that we are paying the entire premium in one, or maybe it can happen that we have a deferred payment, so we are paying the premium earlier, and then after some time passes, then the annuity starts to happen. In this case, we can think about that it's behaving much more like a pension. So sometimes pension funds, at least private pension funds, can operate this way, that you get you have an investment and then you are converting it to an annuity. Also, we can see the endowment. So in the case of death or expiration, we have the payment, but in this case the expiration of the contract will provide us also payment. So if we are living long enough and we are not dying during the contract, then we get payment. And if we are able to elongate the contract or not dying during this process, then we can get some bonuses. Also in the case of ordinary life insurances, we can have different versions, as you can see. So we have beautiful colors here, and the most ordinary version of it is the whole life. So it means that payout will be certain, so sooner or later everybody dies, but the timing is obviously not. And that's why it can have higher premium payments, because this uncertainty must be modeled. Obviously, that's why we have mortality tables. So if you remember on statistics or demographics or some kind of lectures, then you can see that there is always this concept of expected lifespan. So expected lifespan is someone is a baby or 1 year old, then it can be 70 something years, for example in Hungary, and we can see that it can be different between men and women, and it can be also different in countries. So for example in Switzerland it's way bigger than in Hungary, and also if people are surviving for, let's say, 50 years, so for 50 years old people it can be the expected lifespan higher because they already survived some filtering events. So these mortality tables can be really useful, and there are different ways to build predictions on them. And for example, big data or not big data, sorry, artificial intelligence or neural networks can be relevant in this case, because several months ago I was participating in a PhD defense where the doctoral candidate, or now the guy with a PhD, was defending his thesis, and practically he was forecasting mortality rates and times with artificial or with neural networks. So you can do it not just with the ordinary ways or traditional ways when you are fitting some trend lines or when you are building a regression to forecast, but also neural networks can be useful in this case for risk management in the insurance sector. And but also we can say that, yeah, but what is happening if we are not thinking about this extra long term? Because hopefully, in most of the cases, whole life insurance can be extra long term, but we can say that sometimes it can be a term contract. So let's say that if someone is taking up a mortgage, a long-term loan, then the bank can request to have also a life insurance, because in case of the debtor is dying, still they can get some part of their capital back, and maybe the people who will inherit the asset, they will not reject this inheritance because of the debt connected to this thing. But obviously we have to change the value of this contract, because as the mortgage is, at least the capital behind the mortgage is paid back more and more, then actually we can reduce also the money behind this, so the payment can be lower, so that's why we can reduce also the premium. Quite strange for me, because right now or several weeks ago I was taking up a mortgage loan, and okay, I had to make an insurance on the building, so I have a property insurance and also a casualty insurance, because if I'm flooding my neighbors, the insurance company will pay, or if the building burns down, then the insurance company will pay also the bank for the mortgage. But I was not forced to make this one, but it would be reasonable. And in this case we can say that this term contract can change. So not just the regular payment, but also so pay on payment premium side, and also in each year. More complex product than just a whole life, when all the premiums are the same. And the payout is also well defined. But what is happening if we are just combining with more sophisticated approaches? Because here in the case of whole life, then we can expect that the insurance company will invest this money somehow on long run. But since they can make a long run investment, then why not to make it more sophisticated in the level of portfolio? So we can say that money market funds can be combined with equity investment and bond investment, or in the case of variable life, we can say that it's invested into funds. We can say that, okay, the trade-off is that we are purchasing some kind of diversification here, because obviously the money market fund will not purchase just one money market asset, also in the case of equity or bond market, so at least we can diversify some market risk away. And also we have diversified portfolio here, because this one is short run, this one is long run, and this is somewhere between. Different risk levels are added, but also since we are investing into funds, then fund investment has also transactional costs. So that's why it can be a bit more expensive, so we can lose some profit by this investment, but it's less riskier. In the case of universal life insurance, we can see that in this case mostly we are focusing only on fixed interest assets, so money market funds, mortgages, bond instruments are invested, so we cannot say that it's as diversified as the variable life. And also we can see that there is a fixed benefit at the end of the day, and some return can be added to this one. And what is interesting, because in Europe we have also the unit-linked life insurance, which allows, is much more like a variable life, because you can have a basic insurance and also you have additional payments, and you can purchase different investment funds, but in many cases, or at least in some years, you can get some tax benefits. Sometimes the government takes it away, but so it's unit-linked is much more like variable life insurance, and also this is variable universal. But Particularly if we are looking on these three things, we can see that they are highly the same. So I cannot see the significant difference. Just here we have a funds, here we have individual assets, and yeah, and that's all the case. And also it can be really useful for the insurance company because in most of the cases we don't have individual insurance companies anymore. Especially on the European or the US market, we have always universal banks. So a bank has its own commercial bank, has its own investment funds, or sorry, mutual funds, has its own insurance company, has its own broker firm, and so on. And that's why they can have many different uh, positive externalities, so synergies can happen because the insurance company can sell or invest the money of the variable life insurances into their own mutual funds. So that's why they can extend their market by providing this product. And it's really nice because mostly people will not take out this money from the variable life contract. In some cases, obviously, there is a chance to buy back some part of your portfolio, so it depends on the contract. In unit-linked contract, you can do this. But otherwise, this is a long-term safe money which will be kept there, which is not running away. So for a mutual fund, and that's why for a universal bank, then it's a great idea to do, or to provide such a product. And also we can say that, yes, there are group insurances, so sometimes companies are generous enough to provide group insurances for their employees, or if the job is risky enough to make this thing mandatory. Okay, but what is happening? What is the case for property casualty insurances? So it's much more like a short-term business. So in the case of life, the policyholder sooner or later dies, but maybe he or she will pay the insurance fee for 50 years, for 40 years, and so on. In the case of short-term compensation, we can think about that, okay, for property or for casualty, sometimes we have to renegotiate the contract. Especially when it's about traffic-related contracts. So casualty, so it depends highly on the behavior and the behavior of the driver and who is insured. And that's why we have these bonus-malus systems everywhere. And if someone is participating in more incidents, then their annual insurance fee can increase. If they have no such history and they are driving without major incidents or accidents, then their insurance fee can go down. And also casualty, it's a nice way because in this case we can limit companies or individuals' legal or liability exposures. Because, okay, we can say that, yeah, maybe the pipe in the flat was broken and then several flats are flooded under. But in this case, we can say that, okay, the insurance company will compensate for these issues. Obviously, because insurance companies want to limit this, in many cases there is at least some payment which is necessary to be made by the insured company or entity, so sometimes it can be 10% or something like this, to avoid moral hazard issues. Other thing in the case of property insurance is that natural disasters can be tricky. So I already mentioned that when you are making an insurance, there is always a short list of events which is not covered by the insurance. So for example, for my apartment, it's like for nuclear war, they are not insuring it, or for high magnetic events. I don't know what would happen with a concrete and steel building with high magnetic environment. I think it's nothing, but okay, let's not try it. Maybe a solar storm can raise issues, but in this case we would lose our atmosphere, so this would not would be the biggest problem in this case. Or also war, civil unrest, it was also listed. Also serious natural disaster, so if meteor hits entire Szeged and it creates a new lake next to the Tisza River. So yeah, obviously we have to rule out some of them, but there are some insurance companies which are still saying that it's still not enough. So if we are securing real estate against, let's say, fire, and usually fires can happen only in one building or in one apartment or something like this, because sooner or later fire services are arriving and they are dealing with this problem. But if an entire city is burning down, like it's happening sometimes in California or in Australia, then there are serious droughts, then these individual events can happen at the same time. And this is the big problem. So it's like for an insurance company, when claims are not independent, it's like for a bank run for a bank. That immediately you have to sell most of your portfolio, you have to liquidate everything, and you have to start to pay. For an insurance company, it's easier because mostly what you are investing on the asset side, they are some kind of bonds, and they are highly liquid bonds. That's why they are regulated this way. So still they can sell it. It's not the case for a bank, where a bank is lending out for long run and it's hard to liquidate. But still, many banks are issuing catastrophe bonds. So they are providing higher interest payments for the investor, but in case of risk happens and insurance claims are reaching some level, then the bondholder, so the investor, has to pay some well-defined or predefined amount of money. It's really funny that it's catastrophe bond is actually much more like a bond with an option. I think that it's not precise, this definition, what we can see here, because it's a bond, but extended with an option that in case of this thing happens, then you have to pay. But until this point, you have higher interest revenues, and also why it's popular amongst investors that there is no systemic risk. So obviously it's not related to the capital markets at all, so that's why we can have diversification opportunities with this one. Just you should not forget that if the, let's say, tornado or hurricane or earthquake or something like this comes, then there is a chance that you have to pay. Okay, and the third one is health insurance. So in this case we can say that there is a regular premium what the insurance company collects, and the problem is that in this case the frequent usage cannot be reduced or balanced out by higher premiums. So you can't say that, oh, you were at the doctor too many times, so now you have to pay higher premiums. So mostly it's forbidden. Obviously, maybe we can find some cases, especially in the disastrous US healthcare system, when it increases, but mostly it's not. It's not happening. And obviously, before such a contract, then you have to have a deep health assessment, because the insurance company must see that what is happening there. Sometimes it's just a query, sometimes we are sending the policyholder to a doctor for checkup. But after that, when they are defining the premium, then they have to deliver. So payout will be triggered by health events like going to hospital, having prescribed medication, or something like this. So I also was able to see such contracts that, for example, if you want to go to an MRI checkup, because in many cases MRI, yes, for example, Hungarian healthcare system can cover it, just you have to wait several months for that, and if you are paying for it, then you can get it immediately at that week. So in many cases, people are going in private for these checkups or for these diagnostics, and in this case you can have, for example, such health insurance, because in this case you don't have to pay. Now it's 40 to 50,000 forints, or with this depreciation it can be even more. Yeah, but still we have to think about different issues. So first of all, still the insurance company can be motivated to diversify some part of it. So it can happen that they are making a reinsurance. So there are specialized insurance companies on reinsurance, or sometimes they're just doing it with other insurance companies, that they are providing some kind of premium on their own to the other insurance company or to the reinsurance company, and if their contract reaches some excessive cost layers, then the reinsurance company should pay also the payment. So that's why the money flows through, or some part of the money will flow through only the insurance company. But in this case, they can diversify some part of the risk away. But obviously, the implementation of the reinsurance company will increase the partner risk. So we have a new business partner in that if they are going to default, then we have a bad day. Also, we have to think about moral hazard in the case of the insurances, because moral hazard it can happen that, oh, I have an insurance, so I don't have to be worried so much or as much. Maybe it happened also with you that, okay, if I'm going abroad, sometimes I forget to make insurance, I realize it when I'm abroad, then, okay, I'm too lazy, I'm there for just several days, so I will be really careful, but sometimes if you are making it, then you are much more relaxed. But the problem is that if you have the insurance, it can happen that you are less cautious, or you have more health demand. Oh, because come on, I have this health insurance, so let's use it, and it can create also additional payment requirements for the insurance company, or more risk taking can happen. That's why for different extreme sports you have to have additional insurances. So if you are just going abroad as a tourist, then you need just a regular insurance. But for example, if you go to bungee jumping or wide water kayaking or something like this, then you have to specify it in the contract, because otherwise they will not pay you. Okay, and also that's why they introduced this deductible co-payment of the policyholder. So I mentioned already in the case of casualty contract that sometimes they are saying that, okay, 10% of the payment has to be covered by the policyholder, or they are limiting, they are creating a policy limit that above this level they are not responsible for payment. And still the problem is that it can create an adverse selection. So if if the management is not sophisticated enough, then it can happen that they are not able to distinguish between bad risk and good risk, or good client and bad client, or but I think that it's much more up to the insurance company. If they are not able to hire people who can select who to deal with, or if they are not able to build up well-defined questions to distinguish between the different client groups, then I think this is management error, much more like management error than user error, because, come on, everybody would like to make insurance, it's just, yeah, ill behavior is not wanted. Okay, then let's see. Okay, this looks quite ugly, but let's talk about risk. Because we can see here that insurance companies can have many different risks. So, first of all, we can see longevity risk. Okay, from a personal point of view, it's not a great problem, because if people live longer, then, okay, later will the payment happen, and if inflation is not built into the payment, then actually it's also good for the insurance company, because they can collect way more money on the client than at the beginning they were assuming it. But if this is an annuity contract, then it's a problem, because at the beginning the client pays the huge money, then they get the annuity, and if they are living longer than it was expected, then it will be the loss of the insurance company, because they have to do this. So that's why this longevity risk is managed by issuing longevity bonds. So it's quite funny, because coupon payment is number of individuals alive and the population alive. So it's funny, because this is how interest rate is created for this longevity bond. And also it's popular among investors, because there is also no systemic risk in this case, so diversification again can appreciate this one. I think that we could say that, come on, cryptocurrencies also don't have so much systemic risk, because they are absolutely not related so much to capital markets, only maybe through liquidity conditions, but otherwise not. But still we can say that at least here we can find something behind the bond, and not just a made-up cryptocurrency. Okay, sorry for the cryptocurrency investors. Okay, other risk is mortality risk. So we can say that in case of epidemics, pandemics, payments will happen earlier. So, okay, for annuities, it can be a great news, because the client dies earlier, so that's why you don't have to pay so much annuity. But for non-annuities, so usual life insurances, it can be a problem, because people are starting to die earlier and also at the same time, which is bad for business. And actually it's quite hard to model such a case, or such a scenario. Okay, still longevity bonds can solve this problem, because still we have number of individuals alive and population alive, so still we can collect some extra funds this way. But yeah, so a COVID scenario can make life insurance companies terrible as well. Also, we can say that it can happen that the collected premiums and all the investments, or the returns of the investment, will not cover the claims, insurance claims. In this case, obviously what happened, that capital requirements must be set well. So obviously losses must be covered from the capital of the insurance company. It's like the same for banks. Just in the case of insurance companies, we can see that there is this Solvency 1 approach, which says that policy provision, so 4% of policy provision can be sufficient. If we want to find the analog in the case of the banking system, we know that in Basel II it was 8% of the loans which were provided by the bank, or loans, yeah, let's say the assets, risky assets, was 8%. So we can say here that in this case it's just half of it. But now Solvency 2 is around the corner and it's much more sophisticated, so wider set of risks are considered. So we can say that this Solvency 1 is much more like thumb rule. If you have to think about something, that we can say that it's 4%, and obviously it can be way bigger. So it's, the same case is for the Basel solvency capital criteria, so it's never 8%, it's always 9%, 10%, 12%. So if central banks or financial authorities are seeing that something terrible is coming for the financial market, they are always increasing this. So what we can expect here, that it will be never 3, but maybe also it will be never 4, because supervision authorities, they will say that okay, let's set it to 5, and in this case if there is some excessive demand, yeah, we can solve it. But obviously it should be limited at some levels, because still it's further investment requirement from the owners of the insurance company, and it just sits there. Okay, if it's a long-term loan which cannot be withdrawn for 10 years or for 20 years, then you can pay some interest, but yeah, so we can say that capital requirements can be an interesting thing, because if still you are losing such amount of money and the owners of the insurance company are not able to cover the losses, then it will be nationalized or bailed out by the government. So then in this case all the shareholders will lose their investment, and then the government will have a new fancy insurance fund which has to be consolidated and sooner or later sold on the market. Also we can see that there can be operational business risk, and also we have to think about investment performance, which is a bit related to the previous point here, because on one hand, on the asset side, we have some corporate bond or some government bond or sometimes money market fund, so some short-term or at least liquid investments. And in the case of liabilities, we have policy reserves against the earlier dying time or death time of the policyholder. So usually what they are doing here, that the average maturity of the asset side should fit to the liability side. But in this case, you have some partner risk. So we have credit risk, we have liquidity risk. Are you able to sell it in time or not able to sell it in time? You have to have some reinsurance companies as partners, and I mentioned that you can have partners. Also you can have banks, and that's why in case of unfortunate events, in the case of bank crisis, then some part of it can burn away. The worst case scenario is a sovereign default. That's why you have to avoid sovereign defaults at any time, because, for example, it destroys all insurance savings. So it's not just, oh, it's good for the state because it can lose all its previous debts. Yeah, just at the same time, it kills all the savings in the banking system and also in the insurance system, and maybe people next time will not invest their money into this financial sector. They will move it to foreign companies, and this creates capital flight. So must be really careful how to do so. In the case of property casualty insurances, we can see that they have to invest into way more liquid short-term bonds. And also there is an unearned premium, so received but held back for future time periods. So in this case, we don't know when will this event happen, but they are way more frequent than and less calculable life. And of course, you could ask that, yeah, but how about partnering? Because credit default swaps or credit default obligations are behaving like an insurance. Because in the case of credit default obligations, you have to pay regular premium payments, and in the case of a default, you get payments. And also, during the 2008 crisis, we were able to see that many insurance companies had such products. That's why they had to be bailed out by the US government, because they were insufficient to deal with this. But the big difference is that in the case of CD or CDS contracts, you don't have to have the underlying asset. In the case of property casualty insurance, you have to have the building, you have to have the company, so you have to have some kind of underlying asset. So that's the huge difference in this case. And we were dealing with CD or CDS at the second half of the semester, so don't have to be afraid that we will not talking about them anymore. Okay, and how can we define the profitability of insurance companies? We have the following ratios. So first of all, we have a loss ratio, so all the payouts made and the premiums earned. It can be somewhere around in this healthy 60 to 80% range. Then we can have the expense ratio, all the expenses divided by all the premiums earned. So these expenses can be loss adjustment. Usually we have to check the validity of the claim. So, okay, I get the report as an insurance company that, oh, there was a hailstorm and then we destroyed the windows, but if you are going there and nothing happened, then obviously you will not pay, but you have to stand there somehow. Nowadays, under COVID, insurance companies started to use phone applications in Europe, so now you have to make photographs. In the old days, people were coming here with their own cameras and doing the pictures. I'm not sure that maybe it cut back short-term costs, but it makes insurance companies lazy. Never good for business. And also we can say that there can be commission, acquisition costs or expenses when they are expanding their market. And also we have the combined ratio, so loss plus expense, and we have to take out also the dividends, and also there can be an operating ratio, so all the investment incomes and all the premiums earned, because there is always lead-lag relationship between the premiums and the payouts. So the premiums are paid earlier at the beginning of each month, and payouts are happening later on. So if we got the payment on 1st of January, then maybe we have to do a payout in 10th of January or 20th of January or maybe just in March. So until this point, still interest can accumulate, which improves actually the profitability of the insurance company.